Should you use your home equity to pay off debt? Scott Terrio is here. Let's begin.
This is Debt Free in 30. Here's your host, Doug Hoyes.
Scott Terrio, welcome back. For those who don't know you, you spend most of your time in our Toronto office at Yonge and King in the big city, but you've made the trip out here to the studio in Kitchener. You've been on the podcast many times before, and I'll put a link in the show notes, but you and I did a podcast. We actually recorded it in the Toronto office, and I believe we talked about home equity lines of credit or something, and it's had like well over 100,000 views.
Like 2018.
It's been a major.
Is that better?
It might have been. Yeah, it probably was 2018.
Yeah, it would have been
before the COVID time.
And that was a big
that
one.
Word. Now we'll get banned from YouTube. So today we've got you back to talk a bit more about the whole real estate and home equity and everything. Partly because you and I see a lot of this in Toronto. And we particularly see a lot of it when we're dealing with the condo market. Yeah. Because people in downtown Toronto aren't living in houses, they're living in condos. Now, obviously, we deal with people in the outer areas as well. So we're going to talk about all of that. I believe this will air sometime in late November. This might actually be your birthday when this is airing.
We're aiming for the birthday.
So there you go.
Release,
so happy birthday to Scott. Okay, so Let's get into this.
Give
here.
a mailing address later for gifts.
I assume they'll all just send you Bitcoin or something.
That'd be great.
So with interest rates shifting and home prices stabilizing. Now, I don't know if either one of those things is true because it depends when you're watching this. Interest rates have not stayed the same for 5 years and home prices certainly haven't. And home prices are different depending on where you are. So as our friend Ron Butler calls them, the dog crate condos.
Who I saw yesterday.
You run into them frequently.
Yeah.
If it's a 400 square foot condo in downtown Toronto, the prices are not doing well.
No.
If it's a home in Forest Hill, they're still doing okay.
Surprisingly a bit, though, those dog crates, the real dog crates, the 400, the 350s even. I did talk to Ron and some others yesterday about that. And they're actually making a bit of a comeback because people are using them as their weekend place in Toronto.
Oh, boy. Because the prices have come down enough.
And also because they have a parking place. So the ones that have a parking spot are now like in demand because people can drive into Toronto for the weekend and park and stay in their condo that they own that's like just about as big as this room right here. And they can go out and do stuff and go back home.
So it's
weird.
It's now the rich people.
It's so bad that it's good.
Wow. So it's like I could pay for a hotel room or I could pay for this.
So in other words, if you've got that kind of money, okay, well, do it. And I don't think this is widespread, but it's just become a thing that a few real estate people have noticed. So weird.
It's unbelievable.
Yeah.
Now, we are not real estate experts. We have no idea what house prices are going to do tomorrow. I have no idea what interest rates are going to do. I don't know if you should go short or long or I don't know any of that stuff. So talk to Ron, talk to your mortgage person, whatever. But what I do want to talk about is the debt aspects of that.
Yeah.
So if you have a property that has equity in it, and I define equity as if you sold the place and paid off the mortgage and everything, would you have money left over? That's equity.
After costs,
After costs, the real estate commissions, penalties.
Real equity, net
real
equity.
equity. So if I have equity in my property, should I use it to deal with debt? So I'll give you an example and you can explain it to me. I've got a bunch of credit cards. So let's say I've got a property that has, let's say it's worth $1 million and the mortgage is $800,000.
That's good. That's exactly the one I was thinking about on the way here this morning.
Okay. So on paper, I have $200,000 in equity. Right. But of course, in real life, I don't, because if I sold the place, I'd have to pay real estate commissions and everything.
Yeah, you'd have 150 or something.
Maybe 150. Yeah. So I go to the bank and I say, "Hey, bank, will you loan me $200,000?" And they say, "No, we will not, because
there's not enough."
Right. You've got to have a bit of a cushion. So a typical mortgage.
And the bank will only loan to a certain level.
Exactly.
Right? That's like, so even if you have the 150, they're probably only maybe giving you 100 or less.
Yeah. I mean, a conventional mortgage used to always be a 20% down payment, meaning they'd loan you 80%. Well, if I've already got an $800,000 mortgage on $1 million property, I'm not getting a conventional mortgage. But I could get a HELOC.
Yes.
So what is a HELOC?
Home equity line of credit. It is basically you tapping the potential equity or actual equity in your home, and it's like a revolving line of credit, but it's secured, I guess is the best way to put it. Like you can use it almost like a credit card. There's an amount you get, right? Mm-hmm. So they give you 50,000, let's say, okay, and you still have 150 on top of that, minus sales costs potentially. So the bank's safe because their LTV is not too high and all that stuff. But you get to use it to your discretion.
Okay,
but it also floats with rates.
Right. So let's say that the bank will give me a $50,000 HELOC.
Yeah.
So the interest rate on the HELOC will be less than a credit card interest rate.
Yeah, because it's line of credit level interest rate. Right?
It's secured by a property.
Yeah,
whereas a credit card is unsecured.
Yeah.
Okay. So should I take that $50,000 HELOC and use it to pay off my credit cards? Well, I got number one answer we just said, lower interest rate.
Yep.
So that on that basis, it's a no-brainer, is it not?
It can make a lot of sense.
Because I'm paying, I don't know, 5, 6, 7, 8, 9, 10% on a HELOC, and I'm paying 24% on my credit card.
Yeah.
It's a no-brainer.
Yeah,
okay.
So it depends on the mix of the credit and the, I guess, average rate of interest you're paying on those 3 or 4 credit cards that we're paying off. If most of them are 18 and a half, some of them are as high as maybe 27 or something, like more of a retail card or whatever. But yeah, your interest rate on the HELOC is always like half that or something close to that. And it's also because it's going on your house, essentially, you're making a relatively short-term unsecured debt into a relatively long-term secured debt. In that sense, at half the interest rate, it makes a lot of sense, right?
Now, so a HELOC has an interest rate that goes up and down.
Yeah, yeah.
A second mortgage is exactly like a first mortgage.
Yeah, renewed every 5.
Or whatever the period
rate
is.
if you did fixed or variable and all that stuff.
And usually a second mortgage will carry a higher interest rate than a first mortgage.
Of course.
Because they're in second position, higher risk.
Yeah.
Exactly.
Yeah.
So we
are seeing that risk now because as I speak to homeowners a lot lately, and we're seeing first mortgage, a second mortgage, a private, maybe a second private, even a HELOC, like let's pile on. Like some of the stuff that I'm seeing and you're seeing, I'm sure, is what I would say is insane. But that is what's fueled this market for the last decade. As the boom happened and everybody blew their brains out, if you're in second, third position, you're probably getting wiped out these days.
Yeah, if the first mortgage is 80% loan to value and the second mortgage was another 10%. So now we're up to 90%. If the price of the condo, the house, whatever, goes down by 20%, they're gone.
And this is where the HELOC comes in. So if you have that 800,000 and your place is worth $1 million that you described your scenario earlier, and you go to take that HELOC out, well, for people who are maybe at more than 800,000 on that $1 million, they might not be getting one because the bank is also looking at these markets and going, okay, this market has already gone down 10 or 20%. Maybe it's got another 10 to go. I'm probably not lending you that HELOC. So you may not be in a position to do this depending on how much equity cushion you've got. And as prices drop, our equity cushion is shrinking. I was talking to someone about this yesterday. Some people are right underwater, right? And that's not the example we're giving. But as you get closer to your full value of the house, well, what's value? Yep. That's the other question, right? Because and
what it is today might be different tomorrow. If you ask 5 people, you're going to get 5 different numbers, especially in this market. Yeah. Ultimately, it's whatever you can sell the place for. And
the market will tell you.
Yeah.
Because as I speak to people and you do who are dropping the prices on their homes to sell them, and I've talked to people who've dropped them 7 times and are still getting nothing, not even like a call. And they're starting to freak out because they're like, well, where's the price floor here? Well, that's price discovery time, guys, right?
And as we're recording this, we're heading into the sort of fall winter season. Okay, well, that's not the great time to be selling. You know, spring is a lot better.
Yeah, you got at least 6 months here where that's probably not going to
There may not be any bids. And the phrase I like is prices are set at the margin. So let's take a 100-unit condo building, okay? And there's been a whole bunch of sales at $1 million. So everybody figures my unit's worth $1 million. But that one guy who's got to sell ends up blowing it out for $800,000. Well, guess what? Every unit is now worth $800,000.
I talked to 2 insolvency lawyers yesterday at this conference who were dealing with developers going bankrupt. And boy, did they tell me that in spades, right? As soon as the first dude freaks out and sells for 800, automatically that's the new level at best.
Prices are set at the margin. Okay, so we probably should have had a script for this show, but we'll try to bring it back. I know. So, should you use your home equity to pay off debt? Okay, so the first answer is, well, sure, if you can get a lower interest rate with a HELOC or a second mortgage, it makes sense. The second answer would be, well, yeah, it's actually simpler then if I've got one payment on a HELOC or a second mortgage instead of 4 different payments on 4 different credit cards at 4 different times of the month.
It's a stress reducer.
So,
and that can be big for people who call us, right? Because they're trying to pay 5 or 6 things, you know, maybe on a biweekly basis. So it's 10 payments a month, and like they're freaking out.
It never matches my pay period.
Yeah, there's always a drag. And that's partly why they got into more debt, because they have a gap of 5 days where they have no money. Okay, well, go to your credit card, and now you do that 12 times a year,
or
12
worse, a
months,
payday loan or something, and then you're toast.
Yeah.
Okay, so there are some good reasons to do it. Is the answer? And I guess if someone comes in to see me, and you'd give them the same advice, it'd be, okay, let's do the numbers. Let's get a real estate guy to tell you what your house would actually sell for, not some made up number.
Yeah.
And then we can do the calculation. What's the penalty to break the mortgage? You got to pay the property taxes, any condo fees outstanding, whatever. How much money would you get? Okay. So maybe the first answer is you sell your house, but the second answer is you borrow against it. And if you can borrow $100,000 at a reasonable interest rate, and you got $40,000 worth of credit cards, okay, you probably just pay it and you're done.
Yeah.
So that's the argument in favor of doing it. Now let's look at the other side of this.
Yes.
So the first problem with getting using the home equity is, as you already said, the reason the interest rate is lower is because it's secured by your home.
Yeah.
Which means if you don't make the payments, it's secured by your home. The lender can take your home.
Yeah.
So you are risking your home.
Well, the threat differential is before you would get sued if you didn't pay the credit cards.
They could garnish your wages. Or something.
Exactly. Yeah. So they garnish your wages. If they go take you to court, they garnish your wages. Now, if you don't pay it, you lose your house potentially. Well, like not immediately or not always, but now you've shifted the threat from a wage garnishee of 20%. That's bad. Losing my house is worse. So you got to make sure you make those payments. And I guess my question is, if we're looking at the con side, is what has changed financially fundamentally since the time when the debt was incurred? And I realize the debt wasn't incurred in one day. I understand that. I understand how that works. But has anything improved or gotten worse since the time when you accumulated the $50,000 in credit card debt? In other words, what's your cash flow like now versus when you had to resort to the debt in the first place? And so are we really solving the problem that needs solving? And when you and I meet with new people every day, all day, the first thing we do is we go back to basics and we say, okay, what do you make and what do you spend? And yes, you and I have preached many times on this podcast and other places that we don't like budgets because people are not usually disciplined enough to maintain them. So a budget is a theoretical or an academic thing, and it doesn't really work in real life necessarily. But I thought about this, and I think we're anti-budgeting. I'm not anti-budget, though, because the first thing I do with a client is figure out their money coming in and out. The ins and the outs. Well, because if you don't figure out cash flow, which is the person's budget, you're not really doing anything. Like, can we do a proposal? Should we do a bankruptcy? Should we do nothing? If you take this $50,000 home equity line of credit out, what's your plan for it? Are you just going to pay until you die kind of thing or whatever? That's fine, I guess. But the big question is, are you going to run the debts back up?
Yep.
Because if you take that $50,000, pay it, and you run them back up, you might as well not have done it at all.
Yeah, if my living expenses are $4,000 a month and my income is $3,000 a month,
or even 3,800, right? Like it doesn't have to be dramatically lower, but if you're living right on the edge all the time, that's probably a lot to explain why you have this much debt, is my guess. And so unless something is different, and so my guess is, okay, let's say there are, just to keep this simple, 50,000, there's 5 credit cards, they're all 10,000. That never happens, but let's say that's how it works. I would say you kill 4 of them outright, gone, and you keep 1. So it's all paid off. So the 10,000 you've got, and maybe even cut the limit to 5, like from the 10.
Emergency use only.
Yeah, travel, whatever, but just enough, right? But I think unless you do that, you're going to regret this because you're going to go back and I've seen recidivism. You've seen it, like it happens, right? And especially like we're living in a time where expenses are way higher than I've ever seen them, frankly. Everyone knows this. Like, you have the post-COVID stuff. You have generational inflation. You have housing that is absolutely unaffordable now. I mean, I'm talking to people who are renting for $3,000 in Toronto, and the place they're renting in the neighborhood is just like, no way that can be. Yeah. And so, unless something fundamental changes in all those numbers, I don't think the chance of you keeping all that credit at zero is very high. Yeah, and we always ask, so tell us about what happened. And the answer might be, well, I lost my job 2 years ago, used credit to survive, but now I've got a much better job. Okay. Yeah, exactly. Totally different story. That makes total sense. Right? But if nothing's different now, you got to wonder, okay, I'm going to pay this off, but then what, right? Yeah, how can I do it? And you and I are big believers in, well, if there is equity, one option is you sell the place, cash in the equity, use it to pay off the debt. Now you don't have any debt. And how often do they take that advice? Because, and part of it is, look, it is my home, and I've got, I get it, a spouse, 2 kids, a dog, a goldfish. It's in the school district I want. There's a whole bunch of reasons to keep it. There are some times where they really should sell, and they don't. Yeah. They still don't. And unfortunately, if the market is decreasing, well, selling yesterday was a better option. Yeah. So, okay, so the first problem with converting house equity into debt is you are risking your home. Mm-hmm. Although I guess you could make the argument, look, if you don't pay your credit cards and they sue you, I guess they could put a lien on your home anyways. So yeah, they could. They don't usually. They usually garnish your wages. But that may be something that they change to, because banks do, alter their behaviors and their credit risk stuff from time to time. That might be a story for 2026. Mm-hmm. So the second issue, of course, is all the money. So how much is it going to cost to refinance? To put a second mortgage onto your property or a HELOC, there are fees involved. Yeah. The bank has to register on title, and guess who's going to pay for it? Right. Well, won't be the bank. Nope. It's generally you. Nope. They might want an appraisal done. There's the legal fees. There might be whatever other fees they charge. So you got to figure out, okay, what is this actually costing me when I do it? Yeah. Because it's not just I'm exchanging 50,000 for 50,000. Yeah. It might be I'm exchanging, 50,000 in equity for 40,000 in cash at the end of the day, or 45 or whatever. Yeah. Like when you're doing this, when you're using a HELOC or a second mortgage, whatever, to pay off unsecured debts, you're doing 3 things. You're paying debt that's unsecured, you are creating debt that's secured, and you're eroding your equity or your wealth. Period. Those are 3 things that are going to happen. Now, the one offsets the other, obviously, paying the unsecured and making that secure. But again, we're back to don't run them back up. I think that's the key here. And I think little else matters. Like if you do this, I think it's a no-brainer as long as you keep the unsecured debts gone, or as gone as possible. Yeah, it's kind of like going on a diet. I lose a bunch of weight and then I gain it back. Or I fill my fridge with Twinkies. Yeah, which we've all done. Like we're not judging here. I'm more of a chocolate chip cookie guy, but I understand if I'm going to go through all that trouble of working out and eating good and losing all the weight, and then I just put it back on, what was the point? And you're right. What you are doing by tapping into your equity is you are converting unsecured debt into secured debt, which gives you the advantage of a lower interest rate. Yep. But it also means now you've tapped into the equity in your home. What happens if house prices go down? Right. So here's the other problem. And I was just going to actually look at that because I have another note that I made about this. So we used the million and the 800,000 example. This makes more sense the more equity you have, the more cushion. So it makes more sense at 700 and certainly 600 because you're still borrowing the 50, right? Not You're not borrowing the other 400. They're not going to give you the other 400, but you've still got a lot of cushion there of equity, and that's to absorb price drops. So it depends also what's your geography, what's your area like, because you and I both talked to a guy recently whose area is down like 30%, not 20. And it just, there's reasons for that. Part of it was, the people fleeing the city to work from home, and then they all got pulled back to work, and okay, all those prices went down, big disaster. But this 50 grand borrowing makes a hell of a lot more sense the more equity you've got. It makes a lot less sense the higher your equity, because the bank is probably not going to give it to you, or they'll give it to you, but then you're choked right off. And if the prices go back down again, you got none. Yeah. And the bank won't like that, because their chance of being made whole in the event of a disaster is gone up, down.
Their risk is higher.
Yeah, their risk is higher.
Well, and what people don't understand about a HELOC or any kind of unsecured debt is the bank can pull it at any time.
Yeah, they can't. They generally don't and haven't much yet, but they can also, like Darth Vader, alter the deal.
Yep. The interest rate's higher. Guess
they can
what?
alter
Surprise.
the deal.
Yep.
Not to compare the big chartered banks to a Sith Lord, but
Scott,
for all you
Scott Terrio,
people,
for any bankers who are watching, that's his name.
Send your hate mail to
just
me.
Put a note in the comments.
Doug.
Yeah, I mean, if you have a mortgage that's got a 5-year term, the interest rate isn't going to change for 5 years.
Yeah.
It's locked in.
Yeah.
But a floating interest rate on a line of credit can go up and down.
A HELOC is like a gift. I've discussed this with people before. It's the bank can do anything they want with it. So they're giving it to you, and it's almost like a blessing. Here you go. Okay, we'll give you this. But yes, they can call it at any time, but they can also cut you off. Right? I've seen that. I've seen people say, I had a 50,000 and they said now it's 10.
Yep.
Okay, that's because things have changed, right?
Yep.
Like the economic the economic landscape has changed. And so as that happens, and we have front row seats for this, of course, because banks vote in proposals, so we see what kind of mood they're in. But that's certainly been happening with people who've become accustomed to, I got 50 grand, I just use it and I use it, and then all of a sudden the bank sent me a letter saying, by the way, that's done now.
Yeah, and what people don't realize is there's a lot of data out there, and most banks are doing a soft hit on your credit report on a regular basis, every quarter, for example. So it doesn't show up as a hit. It's not affecting your credit score or not.
But they're watching it.
But they're watching, and they go, so this guy has always had $20,000 of unsecured debt. He's always had, pretty low utilization, never a big deal. But wait a minute, now it's up to 50,000. Our risk just went up.
It's a computer doing it.
Yeah, it's not a human.
Probably AI, but they're running macros, I guess, to use an old outdated term. But and they're looking at at swaths of people in their database.
What's changed?
These guys are okay. Totally okay. These guys are pretty okay. We're not worried about them. These guys are starting to get into some trouble. These guys were already after, right? And when I say after, it's just banks adjusting things. They're not like shutting you down. But they're saying, okay, no more HELOC. Okay, or your unsecured line of credit is now capped. I've seen that lots lately, where people, I don't know, with a bank, they had 2 unsecured lines of credit joint with their husband for 20 each, and now it's 10, or it's gone. And that's just the bank reining things in. That's normal. That's been happening since the pyramids, right? Lenders go, okay, things aren't great. The price of sand has gone down.
That's right. For the pyramids we're building.
They're running out of that.
Yeah.
But this is all it is now is digital screens. But it's just the banks retrenching and going, okay, let's take a breather here.
Yeah. And if they're capping your limit or increasing the interest rate, what they're trying to do is encourage you to move on to a different lender.
Yeah.
So before things get really bad, if you can leave, that would be great.
Yeah, preferably to our main competitor.
Yes.
That'd be great.
That'd be fantastic.
Yeah. And I think this is when you're taking out a HELOC or something like this to do this, you have to look at some of those market dynamics, right? Because the first thing we talked about here was, okay, what are rates at? Okay, well, I think everybody agrees rates are going to go down once more this year probably. But now I saw something yesterday from, I think it was Desjardins, saying by the end of 26, they're going up again, or maybe not even the end. Yep. And so where are we at with rates, right? And if you're on a floating rate, which is a HELOC, okay, it'll go down. Maybe after you take it out, it's going to go back up. It might go up again. Now, that might not be a huge deal, because it's still probably a lot better to have a rate go up twice on a HELOC at a much lesser rate overall than what you were paying the credit cards on. Okay, I get that, but it might not be the same deal. It's not staying the same.
Right. And it's a risk. And that's why in some cases you're better off if you can't stand the fluctuations, well, you talk to your bank and say, hey, instead of giving me a HELOC, can we renegotiate my first mortgage and tack it onto that?
Or second, yeah.
Or second, so that the rate is fixed. I know what I got to pay. Maybe I end up paying more.
A key point here is don't automatically gravitate to HELOC. Think about this. Talk to a good mortgage broker, right? Talk to somebody who can say to you, well, with the way things are going, like, I don't know if that's the best, if it's best to be subject to fluctuations right now and just lock it in. Now you know what you got, right?
Yeah. Yeah. I mean, over the last 20 years, variable rate's been the way to go because interest rates have been in a downward trend until they're not.
Yeah.
And when they snap back up, you got a problem. So maybe you're better off paying an extra 0.5% or full percent or whatever for the certainty of knowing exactly what you got to pay.
I was just thinking of the term certainty. A lot of people who call us are really, really craving certainty because they really have none right now, right? Like they go from wild to certain, right? In a proposal scenario anyway. And that alone helps people a lot, I think. So if you can get some certainty and get rid of the unsecured debt and cut up those cards, I think you've come out of this very well.
Yeah, actually. Which is, and you've already addressed it. If it doesn't solve the problem, then you're making it worse. So you've got to cut up the old cards. You've got to change your spending habits to make sure that your expenses are less than your income.
Yeah.
It's like, okay, I guess I'm learning to cook. I can't be eating out every night or whatever.
I got a lot of people giving cars back lately.
Yep.
Because, the $1,700 a month that you and your wife are paying for those two cars is killing you. Like it really is. And I go on about cars all the time. People who follow me will know. But there are only a couple of big expenses you can change.
Yep.
Your house and your cars, pretty much. Like food, you can save a few bucks, I guess, on coupons. But if you need to make a fundamental change, it's great to do it when you're doing this. If you can get rid of a car or get a different car that you're not making payments on or something, because then you won't end up resorting back to the credit cards again.
Yeah. And you've actually solved the problem.
Yeah.
So
a cash flow problem. Yeah.
So to summarize here, using the home equity to pay off unsecured debts, might make sense if you've got stable income, you've got the ability to repay it. The debt is a moderate level. There's a realistic time period when you can pay it off. And you've got, your own safeguards in place. So I don't like the word budget, neither do you, but okay, I know where my money's going. And
well,
I've
you
got
at least
control
have to have a snapshot of your budget.
Yeah.
Or like when we do a budget with somebody, it's just now, right? I just want to see what's going on now, right? I don't expect you to do budget as a verb.
Yeah.
But I like to do a budget as a noun.
Yeah, and I'm a big believer.
I don't know how I ended up with a noun and verb thing, but that's how it occurred to me.
It's Scott's grammar.
Well, it's a one shot, right? If you're sitting down looking at your income and expenses, that's a one-time snapshot of your cash flow. It's not, it might tell you how we got here. It's not going to tell you necessarily what's happening going forward. That's budgeting, which I think people suck at because they don't have the discipline to do it.
Yep.
But you need to at least recognize things that you're doing wrong.
Right. And so pull out your bank statement, your credit card statement for the last couple of months, go through every item and go, maybe some things can be changed here. I like setting up everything on automatic payments. So my hydro bill comes out on my payday or whatever. And that way I know exactly what's happening and I can get into a bit less trouble. So okay, it makes sense if you've got stable income, you got a plan. It maybe doesn't make sense if you're already struggling to make ends meet. We've already talked about that. And I mean, maybe you're just buying some time until your situation improves. Okay, well, you got to think about what the future looks like, but there has to be some kind of clear plan going forward. So what are your concluding comments on this then? Is there anything we haven't talked about? And again, the question is, should you be using your home equity to pay off debt given the situation?
I would go back to the later comment in their discussion, which was, it depends how much equity room you've got. I think for me, I wouldn't do it unless I had a good cushion beyond what I was borrowing on the HELOC or the second mortgage. Because I think we don't know what's happening right now. Like this could be a fundamental correction instead of a temporary one. It could be more widespread in terms of, it's not just Toronto condos and Vancouver condos that are getting killed. It might be worse than that. We don't know. And I think you want to be very careful. And of course, the bank will help you be careful here to a certain extent. But if I'm at $700,000 versus $8 on $1 million property, I would think about doing the HELOC. I'm conservative enough to think if I was at 8, I wouldn't. Because if you take that 50 and things go down a bit more, you got no equity. And that's all of a sudden, it depends how long you've had the house, but if you've had it a while, you're going to feel pretty bad at, living there 10 years and now you got no equity.
Yeah.
Oh God, like I'm getting nowhere here. So I would be careful to have an extra cushion of equity, and otherwise I would maybe do something else, whether it's a proposal or not. I'm not saying that, but I just would be careful to give yourself enough room after what you take out and then cut the cards.
Yeah, and we've got lots of people who come and talk to us about this. And so when you sit down with you or me, or we do it over the phone or video or whatever, it's like, okay, show us the numbers. What do you owe? Let's get someone to tell you what your house is really worth. Let's figure out what the mortgage, do all the math. And in some cases, you're right, a consumer proposal is the correct answer.
Yeah, it could be.
Because if you've got $50,000 of equity in your house and, $50,000, $60,000, $70,000 worth of unsecured debt, well, you can't refinance to get your way out of it.
Yeah.
So maybe the answer then is that you do a proposal.
Yeah, I had a guy
to
do
clean
a
up the
proposal on a zero equity house last week.
Yeah.
And okay, it's going to take him 4 years or 5 years or less to pay the proposal off, but he keeps his house. So he's in the same position as the house, but now his debt's going to be gone. I was going to say a minute ago, a lot of people that talk to us when we sit down and look at what their situation is, what they didn't do along the way was worst case. They didn't worst case situations. And if you don't do that for one thing, you might get away with it. If you don't do it for another thing and another thing, which I'm seeing, you get killed. And that's why I keep harping about the equity cushion, because in a market like this and in an economy like this, which is really bad, I think it's worse than people think it is on a number of fronts. I think you got a worst case a lot right now. You got to be very careful, because if you make a jump and something goes the opposite way you thought, you're going to be in bigger trouble. Yeah.
How secure is your job? How good is your health? What can possibly go wrong in the future? And for some people, renting is a safer option. Yeah, okay, the landlord can kick you out, whatever.
Even for a while.
But yeah, it doesn't have to be for the rest of your life.
I've had people do that as recently as this past week or two, where they've just said, okay, I'm just going to rent for a few years, get my life back in order, get rid of my debts, and rebuild. And especially if you're on the young side, right? I was talking to a guy who's 27, and he's like, I'm already 27. I said, already? Dude, I
what do you
wish
think
I
it's
was
like
27.
to be 61?
Like, you got so much time left in the marketplace, right? Yeah. From the financial marketplace. This is a 4 or 5 year event where, 6 years from now, you're going to be laughing because you got income, you got no debt. How many young Canadians are going to have no debt 5 years from now? Not too many. Yep. And so back up a bit and have a look at where you're at, right?
Yeah, and that's hard to do. But again, that's why you talk to an advisor, you talk to a trustee, a mortgage person, an accountant, a lawyer, whatever it is.
Objectivity is big.
Yeah.
I can sit and look at that and say that.
Yeah,
now, whether they listen or not is different.
We have no
right?
emotional involvement in your situation.
I can say to somebody, God, you're 27, dude. You just don't worry about this longer term, right? You've got to address a problem right now. You have no choice but to address a problem right now, and later on you'll be happy you did.
Yep. I think that's an excellent way to end it. So the answer is home equity can be a tool if you've got it, but it's not the solution in and of itself. Maybe it reduces interest, but I think you and I both agree you got to explore all the options.
And you got to look at your fundamentals and ask yourself, how did I get here, and is that different? And you can't reoccur the debt. You got to be, if you're going to do this, absolutely do not run it back up.
Right. I've got to deal with the underlying issue before I start refinancing. So excellent. I think that is a great way to end it. You can, if you're listening, you can go to hoys.com and in the search bar there, you can look up stuff on mortgages, second mortgages, debt relief alternatives. We talk about all of that there. Our consultations are free. So you want to talk to Scott, you want to talk to me, you want to talk to Ted, whatever. We'll give you our thoughts and we'll tell you how we're coming up with the numbers, and then you can decide from there.
We're so not shy.
That's right. No, we'll tell you. We'll tell you what we think. We have opinions on everything. So Scott Terrio, thank you very much for being here.
Thank you, Doug, again.
For those watching on YouTube, you got to click the button, the notification, the subscribe. I don't know. All the buttons there. The love button.
There is one.
And if you disagree with what we've said, well, you put a comment in there. We'll take a look at it. We're giving you our opinions based on our experience, whether we're 100% infallible or not. I don't think we are. And if you're listening on the audio platform, Spotify, Apple Podcasts, same thing. A new podcast comes out every Saturday morning, including perhaps on Scott's birthday. You just never know.
Send gifts accordingly.
There you go. That is our show for today. Thanks for listening and watching. Until next week, for Scott Terrio, I'm Doug Hoyes. That was Debt Free in 30.